Okay, so what we're going to do today is we're going to look at what's going on in the U.S. Treasury and, okay, U.S. Treasury is going up. That usually means the stock market's going down. So let's look at the stock market. Okay, the Treasury is up. Let's look at the stock market. It is right, hold on. Okay, so the stock market's going down now. Okay, so if we look at our stochastics for the S&P, we can see we're at the top of the range of our channel, and we're overbought in a major way. So this is the time where you don't buy or you sell. It's like the perfect time not to buy and the perfect time to decide to sell something if you want to sell it. And let's look at what's going on in Young Finance News. We saw there's a start of a lot of layoffs. There's a lot of news stories about layoffs recently. Google and a lot of big name companies. And that usually happens around recessions. So when we're trying to keep track of these things, we're trying to also predict, when the next recession could happen. We had like a GDP report from the fourth quarter come out this week that said the economy is still strong. So that means the recession might not happen until July or August, if it ever happens. But right now, it looks like the economy is going pretty strong. What's happening right now are, we look at our average stock market returns. We're going into one of the worst months of the year. We have August and September are bad months. February is usually 0.29, so that's not that great. So seasonality-wise, we're exiting one of the best months of the year, which is January, and we're going into February. So on top of all of that, we're overbought. So if you put all those things together, it's not a good time to buy because there's a chance February is not going to be that great of a month. And we're overbought. So that's why I have the next two weeks or 3 weeks as possible going down. And we have a lot of tech reporting that is going to happen in the next week or two. We have Microsoft, Apple, Amazon, all the big tech companies, and like maybe 3/4 of the S&P 500 report in the next 2 weeks. That could make the stock market go up and down in a major way. All right, so what I'm going to do today, we're going to go over real quick the fundamentals of how to put together a portfolio, and we're going to go over some of the information here first about what makes the stock catalyst for market going up and down. A lot of the variables we have to go into the stock market are positive this week. We have both the treasuries are down this week, around 2%, the 10-year and the 2-year. That's usually good for stocks. And the stock market actually went up. So our pattern of the treasuries going down and the stock market going up is still intact. We have a lot of stocks going, 70% of the S&P stocks are over the 200-day moving average. And the stock market is really bullish right now. People are excited about buying stocks. And there's a fear of missing out. But that's usually what happens at the top of markets. So that's the big picture is people are excited right now. That's not the time to buy. That's when everyone is super excited and we're at the top of a channel and people are buying. That's the time that you don't buy or sell. Our pattern of the U.S. Treasury going up versus the S&P going down is still intact. So the Treasury has been going down this week and the S&P has been going up. So that's even happening today. Okay, so there's nothing really new about the major variables in the stock market. Oil is still around; it's really low, so that means there could be a slowdown in the economy around the world. Fear and greed; people are getting greedier than last week, so that's really a cautionary sign. You don't want to load up and buy right now. In the sentiment survey from the AAII, they're bullish too. They're less bullish over time now. So whenever people are bullish, take some caution. When they're bearish, it's time to hold your nose and buy. Dollar is unchanged since last week, but we're in a downtrend. That's good for stocks. Right now, everyone's super excited. We're at the top of our emotional chart. So everyone's super excited and buying. And that's when the true traders are selling. It's called feeding the ducks. When everyone's excited, the true traders are trading their stock to the suckers that are getting at the top. And that's just when the stock market goes down. We're going to have some earnings reports come out, and just one bad report from one crucial company could make the stock market go down. We do have some of our major issues that may lead to crash. Tesla went down 10% on earnings. They're actually, we're going to go over it later, but they're turning into a regular car company, it seems. Car companies aren't very good growing companies. They usually grow like 5% a year. That's not very good. And if there's a lot of competition, Tesla has all kind of problems, and that's one of the Magnificent Seven stocks that's turning out to have a bad report, and it's going to start going down. We have commercial real estate defaults. That can be a major problem too. Most of the office loans are underwater. So that's really bad because a lot of the banks have them on their balance sheets, the smaller banks. And there's still problems shipping things like oil to America and around the world. So those are the major problems that could cause one of these capitulations. You got to be ready for that. All right, so the P/E ratio hasn't changed since last week, and it's still, the stock market is still overvalued by like 15%. Keeping track of the worst first. Last year, IT was the best, and right now it's actually turning out to be the best sector this year. But some of the worst performers last year, utilities are down also this year. And healthcare is actually up when it was down last year. So healthcare is starting to be an outperformer. The interesting thing about the mortgage rates, they're starting to go down, but there's no flood of inventory on the market. So this increased housing demand is going to happen, but the banks are actually, I just found this out because I'm looking for a house. The banks are actually not flooding the houses on the market, even though there's a lot of delinquencies out there. They're actually fixing up the house and selling them for top dollar. So the banks learned a lesson from 2008. There is a crisis right now where there's a lot of delinquencies, but they're not flooding the market with inventory this time. But we're keeping our eyes on this AI revolution because that's juicing up a lot of the stocks that are involved with that. All right, so what I'm going to do is I'm going to, here's a little note from Twitter. Bloomberg reports 14% of all commercial real estate loans and 44% of loans of office buildings are underwater, negative equity. Now, the amount owed is greater than the property itself. And that's could turn into a major problem for the banks and for REITs and a lot of other related items, entities. All right, so what I'm going to do this week, we're going to put together a portfolio. We haven't done this yet. I'm surprised. And I'm going to go over some of the decisions that you make whenever you put together a portfolio. First of all, you got to see your needs. And everyone is starting at a different spot. When I started investing in 2007, I started off with this growth calculator. It's remarkably accurate. I'll show you my growth calculator from 2007 and how it actually, I calculated within 10% of the amount of money that I have right now in 2007, just by a simple calculation. This right here is, you fill out the highlighted areas, your age, your starting investment, and the growth rate that you want. And you basically figure out how much you want by a certain year. So if we start this year's, let's see, 2024 and age 33, start with this much, and then you want to grow at this much. So it's grow at 0.08. That's how much the stock market returns over time. So you have to think, well, in 10 years, that's 24, you want to have $1 million. There it is right there. So you'll have $1 million if you start with 100,000 and you grow at 8%. And we're not keeping track of taxes and things like that and dividends, but that gives you a vague understanding of where you want to be at a certain time. And if you want to have 2 million at that time, you got to like crank that up, like 15% return. Okay, so this is a 401k, and this is your regular account. So I had like two separate calculations, and then it adds up for you in the end. So if you want to have $2 million in 10 years, you got to basically make 15%, 25% in your 401k. And the other factor is how much you want to contribute every year. How much are you willing to put into this? And that goes right here. So once you fill these things out and you figure out how much that you want, you got your number. That's your 15% that you want. You reverse engineer basically the numbers that you need. And then what you do is you go to our investing spreadsheet, and we use these growth rates and these yields to come up with what investments that we want to put our money into to achieve those growth rates. So for instance, if you want 15% growth, you might consider Meta, which is growth rate is around 15%. And then Google has a growth rate of around 15%. So those two might be two investments that might allow you to achieve that 15% growth rate. And what we do every week when we meet is we kind of go over this growth rate and is it still meeting our expectations? For instance, if we go to E-Trade, I'm looking at Intel right now because that's in the news. But Intel just came out with earnings, and it doesn't. Well, we have to see if are they still growing. And we'll do the same thing with Google. Let's say, let's see if Google. And I do this every week, just because it's an exercise that you do as an investor. You don't have to be this detailed, but I keep track of the growth rates, and you divide these years by year, and you get the average growth rate expected by the analysts. And that's how you get these numbers here. Okay, so I'm going to go over. Okay, so we all got the reverse engineer. How much what your growth rate is. So if you want your $2 million, a good number for retirement is $2 million. I mean, most of the surveys people do online, they try to get $2 million for what's comfortable for them for retirement. Okay, that's the first thing you do. Second thing is, I want to show you, this is that same calculator that I filled out in 2007. And at the time, they were paying 5% yields on CDs. So I was excited to get 5%. I was planning on putting my money in CDs forever at 5%. And I put my salary in there, and I took out $14,000 for expenses. So I was like majorly saving everything that I had, and I grew it at 5%. For my retirement, I put it into a regular, like a mutual fund, and it was growing at 10%. So even though the numbers have changed over time, even though my expenses have changed and my salary has changed, having this filled out and being able to visualize, what it's going to be in 20 years allowed me to achieve that. So I'm just saying that it's a good idea to start something like this now, so you know what your growth rate should be. And so anyway, it was, after calculating all this, it came within 10% of what I have right now, which is, I thought that's pretty amazing. So this is the first step, is filling out this. I think everyone has it in the files section of our chat. It's called the compound growth calculator. That's the spreadsheet. Okay, so now the second thing you do, once you have your number, your growth rate, and the higher the growth rate, the more risky it's going to be for you and the more volatility it's going to be. So you have to be willing to have ups and downs when you get a higher growth rate. All right, so let's look at choosing the investments that meet your yield and growth rate. So you have a yield section of the spreadsheet that I distribute every week. We have the investments. This investments has all the growth rates, all the yields, and all the growth rates that I've been keeping track of. And so basically you have to choose some stocks, that you're comfortable with. After we go over these every week, and I have a certain comfort level with every stock. So I put more money into stocks that I have a higher conviction in. So I guess you got to have your own conviction. I put percentages down for my conviction. Let's go back to my right here. So I have a confidence level with every stock that I own. Like Apple, Alphabet, Microsoft, I have like 100% confidence in Microsoft. That's like the highest level because they're so diversified. They're getting into AI, etc. But there's some of the ones that I have the least of, like T-Mobile. I have a 60% conviction. That's not that great. It's a very small positioning. But you got to figure out your comfort level with every investment and then put more of your resources into that. Okay, so let's go back to what it takes to put together a portfolio. Okay, so you choose your investments, and then you have to figure out the proper mix of growth and income. So here's some online. They have some charts. Like if you're age 0 to 25, you probably want 100% of your stocks, money in stocks or growth in your bonds, 0%. And as you get older, you want more of your money in fixed income or bonds. And the way I think of things, I don't know anything about bonds. I replace that with dividend-related stocks. So as you get older, you want more of your money into income-producing or bonds. Okay, so now why do you want to buy stocks and what individual stocks? In general, it saves you money. Number one, it saves you up to 1% a year. So if we go back to our compound growth calculator, let's say growth rate 15%. Now, if you have your money in a mutual fund, you're not going to do as much work like I do. But if you look at how much you get, let's keep track of what we have at the end of year 2040. That's 4 million if we have 15% growth. Now, if we have 1% going to the mutual fund company, that 2040, that 4 million turns out to be, wait, did I get that right? 2040. Okay, so that's if you're getting 14%. Let's say if you get 13%, 2040, you have a sizable amount less. You have 3,700,000. You have $500,000 less because you have your money in a mutual fund that takes out 1%. Then that adds up after a while. That was my point. So that's one reason why you have individual stocks. Another reason is, for me, it's fun. And the other thing is you have a little bit more control, and you can actually, when things are on sale, you can buy them, and it's like a game for me. But that's the main reason. You pay fees whenever you have, even if it's ETFs, there are fees involved with that. But you can buy mutual funds or ETFs or just the S&P 500 if you want to keep it simple. And you'll save the hassle of doing all this research like I do every week. The next thing you do is once you've figured out all the stocks that you want in your portfolio, say you've chosen 1 of AbbVie, 4 of Abbott, etc. Then you got to figure out a good time to buy the stock. First thing you do is you wait for the stock to be oversold. Every stock goes on sale. You just have to wait for it. And Warren Buffett says you have a limited amount of time to wait for your perfect pitch. And there are no balls. There are no counts whenever you're, it's like in baseball. There's no counts. There's no balls and strikes. You can wait as long as you want for your stock to be oversold or on sale. And the reason why we go over these stochastics every week is there are times to buy it and there are times to sell it. And a lot of times stocks follow these channels, when they're going up. And there's times whenever they break out of these patterns and then you can't rely on it anymore. But in general, you try to buy the stock whenever it's the bottom of the channel and the stochastics are low, like under 10. And when a stock is at the top of the channel, you either sell it or you don't buy it. And here's another indication. This is the current S&P. You would buy it here in November, and whenever everyone's selling and there's it's oversold, and then you would sell it like right now when it's super overbought, or you don't buy it. So it's timing your investment. So that's why we go over both every week. It's here's an example I put together my current portfolio, and the other thing you have to keep in mind is you have to have a mix of stocks in different sectors because every sector goes down and up at different times during the year. So if we look at this annual S&P performance, you can see that telecoms went up, and you have the tech went up last year. You had the S&P up 13%. The financials went down 1%, right? So you want to try to have a mix of different sectors in your portfolio so that you have that diversification whenever one sector goes down in a year. So if you look at my portfolio that I have most of my money in tech right now because I've been focusing on like a mutual fund growth mentality for a majority of my portfolio because I'm trying to target around 15% growth. And over time, this portfolio has returned 13%. So in my growth portfolio, in my growth calculations, that's why I have 13.13 because it's returned that over time. But you have to do your homework and make sure these stocks are still growing. And that's what we do every week. We look at articles and we say, well, is this going to hurt this company's prospects going forward? Is it still going to be growing? But you see, I'm like super overweight tech right now. That's not that great, but it's the hand that I was dealt. I'm not adding to tech. I'm basically holding and diversifying over time. And you can see my healthcare is around 10%. You have to like this is like kind of diversified. But if you look at mutual funds, I've been modeling my portfolio off of mutual funds. So let's look at some more mutual funds. Hold on for a second. Okay. I do this on a regular basis. I look at, what the mutual funds are holding. And over time, this is 2 years ago, they were holding basically the same stocks minus 2 that they're holding right now. Fidelity Magellan is one of the largest mutual funds in the country. They got rid of their Apple and Procter & Gamble, and they added to all the green positions here. They had Microsoft, they had that increased, NVIDIA, Meta, United Health, Eli Lilly, and Broadcom. So you can see that good mutual funds, whenever you pick a stock that's a good one, like Amazon, Meta, Visa, Google, a lot of times you can hold those for 10 years and they'll be still growing. And that's why I'm modeling my portfolio off of mutual funds. And when any of these stocks go on sale, that's a good indication that could be something you can start putting a little bit into at a time. Like last year when the tech was selling off, I was mentioning at this meeting at this time last year, I said, well, it's time to dollar cost, put a little bit at a time into some of those names that are in these top 10 holdings of the mutual funds. And that's actually how, when I dollar cost, I put like 0.5% or 0.3% in at a time. That's not a lot, but it adds up after a while and allows you to put in little bit in at a time, and that adds up if it actually turns out to be a good position. All right, so so over time, you'd probably want, if you're interested in an all-stock portfolio, you'd want to put a little bit in at a time, and that'll balance out your average cost of your investment. When I first invested in Alphabet, for instance, my first purchase was like $3,000, and I waited a month and I bought another $3,000 position. The same thing with Apple. That was in 2008 or 9. I bought like 1,000. I put a little bit more in, and in Microsoft, I bought in 2007, and I bought like 200 shares of that. But that was a very small $2,000 position. But over time, I put a little bit more in every year, and that actually, it grows to like a larger part of your portfolio over time. But that allows you to average the price that you buy it at. And the hard part is you have to make sure these stocks are continuing to grow over time. And you have to have a thesis, and whenever news comes out, you can't be scared and sell out of it because someone's saying something online. You have to have your own conviction and your own reasons that you own things. So once you've figured out all the stocks, your percentage, and then the stocks that you want to invest in, then you have to figure out, how much you want to put into each one of these. How many shares do you want to buy? And you can do this on paper. I mean, this is a spreadsheet, so you can add these up and say, I want 2 shares at Costco, 4 shares at Google, and you can see how much it's going to be over time with this spreadsheet. And you can do it acting like it's your own money. It's paper trading. But what that does is that really gives you some skin in the game. If you invest even just a little bit, that gives you the interest to follow that stock and to learn more. And that's how I got started. And for me, it's a relaxing thing to do, is to follow earnings reports and everything like that. So, okay, I thought that was an interesting thing we never talked about before. Any questions on that? All right, no questions. All right.
Yeah. No, I think it's good. So, yeah, that you just your thesis on the mutual fund costs earlier, that there are, depending on, there's a big difference in costs, right, between different funds and ETFs, and that's really something to pay attention to, are those management fees.
Yeah, the ETFs, especially the ones on Fidelity and Vanguard, they're almost zero right now. They're like negligible.
For the index-based ETFs, yeah, you can buy like actively managed ETFs that have fees, higher fees.
Yeah, like ARK ETF, that is like huge fee, ARKK, so the advantages of doing your own stock selection, actually, it goes down whenever you don't want to follow things like me. Like I'm totally into this. I follow this stuff. Every day I'm looking at the news and everything, but it's my comfort level. I guess, Matthew, you have like an ETF comfort level, right?
Yeah, I do some individual stock picking, but most of my retirement funds are in index, mutual funds or ETFs. Yeah, with low expense ratios.
Yeah, that's a really good. I mean, if you don't want to do the research like I do, that's a good approach, because it's easy to get in and out of index funds. It's easy to dollar cost, and you're not really. It's safer too, because you can actually, whenever a sector is down, it's easy to dollar cost into that sector. If but when you don't have individual stock if one of your stocks goes down, that could take your whole portfolio down, and you have less of a risk whenever you have ETFs, approach to investing. So you're following the same strategies when you're using ETFs. You're trying to have, a certain portion of your money in different sectors. And one thing I broke out here is kind of interesting. I broke out the growth in income, how I do my allocation. So right now, if you have like maybe 70-30 when you're 65 years old, 70% in stocks, 30% in bonds. What my approach to this is I have like a 70-30 portfolio here, but I have 70% in growth, and 26% of my portfolio is yielding. It's like more for yield. So that's how I'm approaching it. I don't know anything about bonds. That's primarily why. And for most of my investing life, bonds have yielded almost nothing. So it hasn't been an option until like right now. So right now, up to now, I've been handling that 70-30 by putting in maybe 30% of my money into income-related investments. So like, for instance, income is 4.24. Abby is you can see that I have it as a healthcare. It's an income part. And then all these are more dividend-oriented because they're Altria. They do like 8 or 9% dividend, and so in general, that's my approach to investing, and it's an approach that I might change if bonds start yielding. I mean, if I understand bonds better, I'd probably invest in them, but I don't. All right. So, anyways, I thought that would be an interesting approach to understanding investing. Here's some rules that I follow just to review for buying growth stocks. I do screens, and I follow these return on equity greater than 12, profit margin greater than 12, market cap greater than 50 billion because bigger companies are more reliable. You try to keep a low PE ratio with a growth rate of over 10, and a PEG ratio, you try to keep that around 1 if you're making a new position. But if it's a really reliable company with reliable earnings, you can pay up to 3 or more. But you try to have stocks that are actually increasing over time. So let's look at some of the stocks that are going up and down today. Hold on for a second; it'll be worth it. Okay, market movers. Intel is one of the biggest movers. It's going down today, 12%. I thought it'd be interesting to go over Intel. I didn't prepare anything for this meeting, but I thought it'd be interesting to go over Intel. To see what its growth rate was. So its PE ratio, that's Google. Go over one more back. Okay. Right. Hold on for a second. It'll be worth it. Okay. Intel is trading for. Hold on for a second. It's trading around a 29 PE. Let's look at this again. Hold on. So it had a bad earnings report today. And we haven't liked Intel since we've been looking at it. Let's look at the growth rates of Intel. We're going to calculate. We're going to look at these earnings estimates here and just calculate over the years what they're going to be earning. So it's 1.49 divided by 2.28. 1.49. 1.49 divided by 2.28. Wow, so that is 35%. Let's look at 2.28 divided by 3.1. That's 27%. Okay, so it's grown at 27%. And let's look at. Okay, well, we're not going to find that out. Let's look at the chart for Intel. It's down 12% today. You can see a lot of times, let's look at the support that Intel has. If I was looking to buy this, I would look right here as a spot where there's support. You can see that in May of last year, it held there, that's support. And right here, at 41, it held here too. So that's a level of support. And then the next level of support is right here. And then you have to go the whole way back down to here, which is 26. So whenever a stock drops like 12%, you got to look at those levels as the next place it could be going. Let's look at the fundamentals for Intel, just for kick. Statistics. Its PE ratio right now is 108. That is just amazing. It's trading at such a high PE ratio. Forward PE is 27. Okay, so that's more realistic. It's trading for a P of 27. It's growing at like 27%. And so it's like fairly valued right now. But the problem with Intel is the big picture is they're behind all of these other companies like NVIDIA and AMD. They haven't gotten into AI, and they're losing market share to AMD for all the data centers. So it's they're trying to turn around the company, and it's not really a good story to begin with. And they're like, so anyway, that was a good exercise. They're down 12%, and these numbers don't take into account the bad earnings report they just had. So we're going to check in this later on to see if it changes. Okay, let's look at some more of our points. So we saw like Intel was actually past that. It's growing at 27% around. But let's see, and it has that CHIPS Act too. So they might be getting some free money from the government for making chips locally in America. Those are some catalysts for the company, but they have a lot of competition from NVIDIA and AMD, and they're not really doing the AI as well as the other companies. All right. Okay, here's a little something I found on Twitter. Here's a way this guy on Twitter looks at stocks. He says you get 4,000 stocks in the stock market, and you put them through this funnel, and then at the end you decide whether you like a stock or not. So this is what Warren Buffett says, the confidence filter. He says, is this business simple? Do I understand it? Is it simple products and services? This is, Warren Buffett wouldn't even look to buy a stock if he didn't understand the business or the products. And he wants a stable company with a wide moat, and then you look at the valuation to see if it's a good price. And if it passes all those, then you buy a portion of it. So I thought that was a little good exercise. They had a very similar way of screening for stocks than I do. The PE ratio is low, return on equity, debt to equity, no debt in the stock, market cap is bigger, and the profit growth greater than 10%. So this chart has a lot of the things that I'm looking at, and we can look at that after a while. Okay, so I'm going to go over some of the, I model my portfolio off of mutual funds. Whenever some of these stocks, like, they go down, I like to start looking at buying them in my portfolio. You can see that Fidelity, Magellan added NVIDIA, Microsoft, Meta, United Health, Eli Lilly, and Broadcom since 2 years ago. So you can see that they kept their Amazon, Google, Visa, and MasterCard. So that's a very good indication that those companies that they did not get rid of, actually, most of these stocks are ones they've held for 2 or 3 years. So that's a good indication that these stocks are still stocks that you can buy and hold and achieve mutual fund-like returns. One thing I did break out is the sector weightings of this mutual fund. They actually, this is almost very similar to my portfolio. They have a very large technology weighting because their technology has a growth rate that's a little more consistent, and it's a higher growth rate. And industrials, healthcare, consumer cyclical, financial, and communication services. So these are all very, very similar to how I broke down my portfolio. And I've actually modeled my portfolio trying to be diversified. I compared my portfolio to mutual funds like Fidelity Magellan. And let me see. I did the same thing with JP Morgan U.S. tech leaders. This is a 2020. This is 3 years ago. They still hold their Tesla, Synopsys, AMD, Alphabet, and Amazon. And they got rid of PayPal, Twilio, Match, Analog Devices, and Teradyne. And you can see by the ones that they did add, those are indication that those stocks are decent stocks or ones that you should start looking into. But you can see their sector weightings. They have the name of their portfolio is tech leaders, so they got to have tech as most of the portfolio. But they did have some real estate, consumer cyclical, and communication services. So I would study some of the biggest mutual funds in the country and see what they're holding. And whenever you're buying stocks, try to model your portfolio to some of their weightings and their percentages for every sector. I noted a couple charts that were interesting, good examples of oversold market, or this is a Brazil ETF. You can see that it hit the bottom of its range in its chart, and it's also oversold and starting to go up. That's usually a time to buy or don't sell. And there's an article on Netflix. They gained 13 million subscribers in the fourth quarter. So they had, what I did was I mapped out, we haven't been following Netflix, but they're actually a good example of a growth stock. And they went down a lot. Look right here, quarter two of 2022, and no one wanted it. And at that time, that was probably the good time to buy it. So it sold off a lot based on subscriber miss. And so at the time, people were sharing passwords, and they actually implemented somewhere around here no password sharing for some of their customers, and they advertised subsidized. Well, they have advertising for some of their offerings, and that actually allowed them to add some subscribers. So they added more than expected subscribers. That's the big number that they look at. So they're growing around 29% right now, and their PE is 46. So their PEG ratio is 1.5. So if we look at this chart, when it went down to in quarter 2022, that was probably a PEG ratio of 1. So this is an example of when a stock, a good quality stock, goes down to a PEG ratio of 1, that could be a time to start looking into it. But the problem is, can the stock continue to grow at 30%? And according to the analysts, it's going to go down every year until it's a 10% growth. So that's the big question, and that's why it doesn't command more of a premium. Okay, so let's look at their chart. You can see that Netflix is basically at the top of their channel, and they're super overbought right now after this 10-12% move. So this is not the time to buy that stock. The time to buy it would be right here, whenever it was oversold and no one wanted it, and it was at the bottom of its channel. So we'll keep our eyes on this one. This could be another one we follow. And let's look at Tesla. This was in the news this week. They slid 10% as management comes off vague on key issues. The big problem with Tesla, they have, not only did they report slowing growth, you can see they only grew 4% from last year to this year. This is like a typical car company only grows 4%. So they might be turning into a real car company with real issues growing. So right now they have a couple issues with Elon Musk. He wants 25% ownership in the company. And the other things are they're having competition problems with China, where China has a more efficient way to make cars. And BYD actually overtook Tesla as the top EV maker in the world. And they're making cars cheaper over there with iron phosphate. They have a lower miles that you can drive them, but they're cheaper. And Elon Musk says that he gave warnings that they might not be competitive with them. And there's all kind of questions about the company now. So the PE is 42. It's a huge premium. It seems like they're estimated to grow 25% the next couple of years, and that's in question. So this is a very questionable company now. If Elon Musk doesn't get his 25% of the company, he might leave, and then there's a premium involved if he's not involved with the company. So all in all, this is turning out to be a very iffy stock. It's very iffy. They might be turning into a 4% growing stock. If that happens, then the PEG ratio go down to 1, and that's like 1/3 of the price it's at right now. So, anyways, we'll follow that just for kicks, but I'm not going to invest in it. You can see that on the chart for Tesla, they just broke out of their uptrend. They were in an uptrend for years, and all of a sudden, a new pattern's starting to form. And this is a downward pattern. You can see that it's lower highs, lower lows. And if this is true, they might be starting this new pattern. Then you can say goodbye to this channel. And that's the example of a red flag. They might go back up into this channel if they have some good news, but I don't know. I'm starting to think it's going to go down. So that's pretty dangerous for people that own Tesla. All right. So let me see. Does anyone have any questions, things you want to follow? We can look at the news online here. What's going up and down? No questions. Okay. Let's look at some of the market movers. Okay. So Intel went down today. They had a bad earnings report. But you can see that when one stock in the sector, this is memory chips. Whenever they go down, every sector goes down in sympathy. Every stock in that sector probably goes down in sympathy. So there's stocks, the KLA, Tencor, there's stocks that actually are suppliers to Intel. And there's stocks that actually sell similar things. When this goes down 12%, then a lot of the other competitors, almost all of them are more than half of them are semiconductor stocks. So when one goes down, the other one goes down with it. And let me see. That's what we learned from that. The ones that did good today, American Express. American Express actually said that they have a large amount of loan reserves for people defaulting on their debt. They have a better customer than Discover Card, and because comparing it to Discover Card, because they have higher net worth individuals that pay a fee that use their cards. So let me see. We have some banks in this top 10 here. Let's look at the 10-year. The 10-year is up, so that's bad for banks. So that doesn't explain why some banks are up today. Let's look at the NASDAQ. We have a lot of high PE ratio stocks. A lot of these ones are high PE, high growth. So the risk is on today. Usually whenever the Treasury goes up, that's bad for the stock market and for risky investments. But it's the opposite today. Wonder why. Okay, let's look at some of the sectors. So if the interest rates are going up, without looking at the sectors, we expect the banks to go down. Anything that needs to borrow money will go down, because as interest rates go up, the cost of capital goes up too. Let's look at what happened in the sectors. Semiconductor, that's because Intel had a bad report. So anything around technology goes down whenever one big bellwether goes down. Gold miners go down, so as the interest rates go up, the home builders go down because people can't afford mortgages. That makes sense. Home construction, same thing. Real estate goes, as interest rates go up, as the 10-year goes up, people can't afford, real estate goes down. So that's a one-to-one correlation. Let's look at what's going up the most. Telecom, regional banking, banks. Okay, healthcare. Okay, these are all high dividend paying stocks. Stocks with they're consistent, steady growing companies. So these are high interest rate. Now, stocks that are more consistent in nature and pay a yield. So that's an example of, if we go back to what worked good last year. So every day this year, we're going to probably have that same battle. The same battle of worst to first. So the stocks that are doing the worst today are the technology stocks. And the ones that are doing the best today are the ones that are more conservative. So, and this all goes around the interest rates. So we can see the oil, the healthcare, these are all ones that didn't work last year, and they're starting to work today. That kind of explains that. Let's look at what else is going down. Okay. That's all we can get from that. Utilities are up today too. Okay. So let's look at the stock market. Okay, so we know by looking at the S&P, we're overbought. And the stochastics are overbought, and we're going down. So it'd be natural for the next week or two for us to go down to where we hit this bottom end of this range, and we go down to the stochastics or lower. And we're going to have a lot of earnings reports. That explains why we're going down now. The earnings reports can be taken multiple different ways, and that's the perfect reason for a sell-off. One bad earnings report from one major company could make the whole stock market go down to this level here. So the reason why we're following all this is, if you're thinking about investing a portion of your money in dollar costing, you want to wait until the middle of February or the end of February, because right now everyone's super excited. We're greedy. If we look at our fear and greed indicator, let's look at that. Fear and greed, extreme greed. We have the VIX is super low. That's when people aren't afraid. So it's all the opposite of what we want when we want to start buying. So what else? Okay, let's look at Dan Niles. Every week we're going to review all of his top picks at the beginning of the year. Right now, his K-Web, his China's tech stocks still aren't doing that great. They're negative 7%. His biotech ETF is negative 1%. Texas Instrument, today it would be even worse. It would be down a lot more. So these three haven't panned out for him. But Amazon is up 4%. Meta is up 11%. So far, these two are doing really good. Let's look at, all right, let's look at more things for hold on. Okay, let's imagine we're in a crash and the stock market's going down. The first thing we do is we look at key levels of support. And if we're in a crash, let's say we're at the top right here, right? You can see we have a double hop from last year Christmas time 2021. We were at the same level. And what I mentioned last week A lot of times whenever you have resistance, that's called resistance, that could be like a ceiling that you can't get through. And that could be another reason why we might not go up from here and we're going to go down. Whenever a stock like market or like an index goes down, you have to look at these prior levels of support. Here's one right there. Whenever it went down to here, that's a good level because it's also the level it's supported right there. And if it goes down again, here's another level, and here's another level of support. And this is November 2022. I mean, yeah, right around there. So that's whenever a stock market, when you have a sell-off, the worst thing you can do is start selling everything that you own because you get bad prices. You know, the bid and ask is never in your favor. And you got to decide when to sell it and then when to get back in. And that's super hard, especially when you're trying to maintain this 13% growth over time. Trying to get out and get back in, you got to buy something that's 20% better than what you currently have because you have to pay taxes and stuff. So these three decisions are really hard to make. If it's selling off, you got to know. Let's look at the S&P. If it's selling off right here, you got to know to buy it right at this time. Are you going to be willing to buy it when it's lower than when you sold it? I don't know. It's really hard. That's why I buy and hold. Let me see. So you got to find something better than the stock that you sold, and on top of that, you have to do it under stress. So that's why it's good to keep buy and hold, and whenever things are selling off, whenever you're over your skis, it's a good time to start selling things right now. Whenever we're at all-time highs and we're overbought, not whenever we're starting a sell-off. So make sure that that's all I wanted to say today. I hope you have a good weekend, and I hope you have good investing next week.
Okay, thank you.
All right, thanks.
Bye.
Bye.